Hello again. Let's make sure we are all good. And let's get this baby on the road here. Let's share this over. How's everyone doing tonight? Good. Just kidding. Let me share this. It'd be cool if we can get a couple people. This is a really good topic. Complete forewarning. I have some preparatory things planned here, as you can see on the screen, but I've never given this this talk to anybody specifically. I hope we're not dropping too many frames or anything like that. If we do, I apologize. I do intend on giving this more than once, talking about this topic more than once, because I think it's really important, like I said, and I truly think that if more people that are especially young, but I mean, no matter what age you are, if you kind of get into this sort of stuff, you don't need to be. I want to start this, this little, I don't know, lesson or whatever. I want to start it. Hey, how you doing, man? I want to start this as kind of. I want to start it with saying that you don't need to be a complete expert in the field of finance to just have your own Roth IRA and things like that. You need to just focus on the basics, get a little bit of an idea of that, and then just kind of go from there. And that's really what I love to do. I like to have everything in a very clean and organized, boom, 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 step-by-step process. If you caught the other one that was the personal finance crash course, that's kind of, what I've just come to know over the course of me doing, what I'm doing from a, personal finance standpoint, business finance standpoint, and all these other things. This topic today is particularly, interesting to me because I know that it is one way to build wealth. It's a very simple, very direct way. And if done consistently over a period of time, you're definitely going to have good results. And I'm literally going to show you the results that I've had in a very short amount of time, just a few years. I'm only 24. So, if you have the capability to save money and you have the means and you're just looking for, and, kind of delay, you're okay with delaying a little bit of, gratification now, in hopes of one day having a better life, better retirement in this instance, or you can do it different ways. The things that I'm going to show you here are specific to a Roth IRA, but some of the principles, especially as we get later on here, are going to be exactly the same no matter what you're doing. I think overall the lesson that you want to take is patience and buying into things long term, and just realizing that, again, I'll show you here in a second, when you put money away consistently and you invest it with the idea that you're going to have a better tomorrow in a little bit of a sacrifice, by sacrificing a little bit of fun today or something, or however you want to position it, I think that you're going to have great success, and you're going to thank yourself truly. In the personal finance crash course thing, I can flip over to it right now. It's right here. Hopefully it's not super slow, but it's literally called, this section is called You'll Thank You Later. So I'm not going to go over the finance crash course. It's just here as a reference, but, the Roth IRA stuff is what we're going to dig into today, because it's had a positive impact on my financial situation, and I think can help a lot of people. So I'm not going to dig into it any more deeper as far as the overview and everything. We're just going to jump right into it. And, yeah, like I said, this is my first talk, and it's my second time doing the stream like this, so, cut me some slack here and there, but we're going to try to do our best. So I'm going to tell you everything that I know. I'm going to try to tell you everything that I know unless I forget stuff about like IRAs, Roth IRAs, and just again, like why you should be doing this stuff. So as you can see, like we'll start here because this is a really good roadmap. Just very simple questions, right? And that's how I love to do this, because there's no need to overcomplicate stuff that is not that complicated. I just think it turns people off tremendously when you try to throw so much information at them initially that it's like you're just dead in the water before you start. So I like to keep it super simple. That being said, number one, again, stupid simple. What is an IRA? Well, IRA stands for Individual Retirement Account. Time out. Let me preface this. I said it like several other times, but I need to say it again. I'm not a certified financial advisor by any means. I didn't go to school for this. I just have watched a lot of YouTube content, talked to a lot of people, and like I said, I'm going to show you like actual numbers why like you should at least take this as somewhat experienced advice and then continue to do your own research, because I think that's always the best plan of attack no matter what you're doing. Anyway, back to the thing. So individual retirement account, that's what IRA stands for. Basically, there's two types of IRAs, traditional IRA and a Roth IRA. There is definitely differences between the two. I choose Roth IRA, and I'll tell you why I choose it in a second. If we flip over to my next tab here, they're similar in nature in the fact that you're putting money away into an account, into an investment vehicle, and that account has like rules associated with it. So effectively, I'm going to get some of these numbers wrong unless I kind of like really look them up, but I'm almost positive like it's 59.5 or 62.5. I don't personally concern myself with those. I'm going to be 100% honest, okay? I don't concern myself because when I put money into one of these accounts, into a retirement account, I assume that I'm not going to touch it until I'm able to touch it without taking it out like with penalties or anything like that. Okay? So that's what I would kind of tell you, I would recommend you to do. When you put money into a retirement account, assume that you're not going to get it out until you're in retirement of retirement age. So we're talking like 59.5, 62.5. I'm not sure, it's somewhere in here, but again, it's not like super extremely important. Like I said, if you're putting money into a retirement account, just assume that you're not going to get it for a while. That's pretty much the case. Also, any questions, if anybody has them, I'll try to answer them as easy as completely as possible. So just throw them in the chat wherever you're at. But so that's sort of the overview of like the IRA specifically. It is a retirement investment vehicle that you're going to put money into and then use it to, and then you can buy different things and invest and all that sort of stuff. We're not into that stage yet, so we'll get there. But basically, think about it as that, an account that you put money into and you're not going to touch it for a very long time, depending on how old you are. So we're talking like 60s and so, okay? So that being said, what is a Roth IRA sort of like in comparison to a traditional IRA? Well, there's a couple differences. I think this page that I'm on here, and if you literally just type in like Roth IRA versus traditional IRA, you can get these things. The main difference, here, let me show you the main difference, okay? Here's the main difference. It's how I was always taught, and this is how I always think about it, because this is probably the most important in my opinion, and it's how you're taxed. So because this is an account that you're making money off of, the government always like wants a cut of it, right? Which is understandable. I mean, we live in the United States. That's kind of how it is. So there's two differences. There's a traditional IRA and a Roth IRA, like we said. And if you look at this very, very simple graphic here, traditional IRA gives you a tax break now, and Roth IRA gives you a tax break later. So with a traditional, let's look at that one first. It's you get your tax break up front and pay no taxes on the money you put in until you withdraw it. So let me try to give you an example here. I don't have a traditional IRA, but let me give you an example. You make $50,000 and you want to put in $5,000 of that money into your traditional IRA that you've set up and you have and everything. As it pertains to taxes, my understanding of the traditional is that you have $50,000 that you are required to pay taxes on, like at the end of the year or whatever, okay? Most of you are probably familiar with that. You get the deduction and everything like that, but that's your income is $50,000 you have to pay taxes on, minus any deductions and all that stuff. Well, the point of the traditional IRA is you put $5,000 into that traditional IRA. Well, because of the rules and the tax implications of the traditional, you take that $5,000 and you deduct that from your income. So now instead of, starting with, we'll say $50,000 and then, doing any deductions or whatever and paying taxes on that, you're actually starting with $45,000, taking more deductions and deducting it off that. I'm not a tax expert either, but that's pretty much the gist of it. In a traditional IRA, whatever you're putting in this year, 2020, it can be used as a deduction on your taxes. Pretty much, loosey-goosey the term there, okay, and the description of what happens there. The reason, and I'll explain why a Roth IRA, in my opinion, is better for somebody like me who just wants to continue to stow away that money in there, is because you don't do that. You don't do what you just did in the traditional. So let me give the same example. Let's say you make $50,000 and you have a Roth IRA and you put $5,000 into the Roth IRA. Well, you don't get that tax break because you're going to pay the taxes on that money that you put in. This was very confusing to me when I first started realizing it, and it was strange because 2 years ago I tried to do the math on this, and every single time a Roth IRA came out way ahead. Now I could be wrong because I haven't done that math in a while, but I still think it's true based on what I want to do. And to give you a brief aside of what I want to do, and again, what I'll show you here shortly, is every year of my life, from now on until, I start withdrawing or whatever, I want to put in the max contribution, which is something we haven't stated yet. With a Roth IRA, I think there's traditional IRA limits, but we're not really talking about traditional IRAs, so I don't really care that much. But I'm pretty sure that there is a limit on both. There is definitely 100% a limit on how much you can put into a Roth IRA per year. Currently, that is $6,000. So that is put in place because what I would think is if you would put in more, you would be at an extreme advantage given the things that we're going to talk about here and just this rule alone. Think about this. If you could put in $6,000 every year for the rest of your life into an account, and you can invest it however you want into stocks, into mutual funds, yada, yada, whatever, that you're going to consistently put in a little stepping stone. Thank you, Shane. Appreciate it. Same on both, right? So if you put in the $6,000 every year on that Roth IRA, your thing is just going to keep stepping up. You're just going to continue to do a linear progression as far as what you're contributing. But given the power of compound interest and generally what I'll get to here in a second, the historic returns of the stock market, which again, as we continue to move through this, you're going to learn a little bit about just the ways that I, figure out how to invest, what to invest in. It's going to pay off. I'm not going to guarantee you because that would be dumb, but I will show you again how, just trust me. We're going through some of the mundane stuff here, but trust me, it'll kind of all start to make sense. So anyway, though, the point of this piece here, okay? Traditional IRA, you don't pay taxes now, you pay taxes later. You're going to pay taxes on all the money that you made, all the money that you put in, and all the money that you made later when you take it out. Roth IRA, as the rules stand here, the money you deposit gets the taxes taken out of. You pay taxes on that because you don't get the tax break now. However, all the money, according to the rules as they are now, which I pray to God they never change, according to the rules, this is all going to make sense when I bring out this calculator, okay? There's a calculator in here, and you're putting in, like I said, a linear progression of 6,000, 12, your progression of deposits would go 6,000, 12,000, 18,000. You don't have to put in the whole amount, but I'm assuming that, right? That's what I do, like I said. So you're putting in, these little steps. but your actual balance is going up like basically exponentially. Okay, it's not like that crazy. It would obviously depend because it's it's the stock market, but that's the point. Is like compound interest. It's not going to go up linearly. Okay, I will literally show you. Like I said, it's hard to explain right now. But the point is, you are not going to pay taxes on all of the money you make. You're only going to pay taxes as you put the money in because you didn't deduct it from your income each year that you put the money in. So, moral of the story is if you can put $6,000 away and spare the tax break, then I think you should go for the Roth. Do your own research, do your own math. I'm going to try to explain it to you a little bit better as we continue on here, but that's what I think so far. It's been working for me so far. So let's move on to the next thing here. So let's go back over here and let's say, so we kind of answered what is an IRA, what is a Roth IRA. So why should you get one? Started to answer that. Let's look at something here. Let's go back to what an IRA is, and like sort of why you should get one. You should get one because you want to save money. You get one because you want to have a better retirement. You want to have money stowed away for retirement. Based on your tax implications, you might want to pick one or the other. The one other thing that I forgot to mention is like a Roth IRA does have income restrictions. Like you can't put into a Roth IRA if you have over, I think it's in here, but it's like over $120,000 single. Like if you're single and you make over $120,000, you can't get into a Roth IRA, like things like that. So you'd have to look at some of those rules. But most people aren't going to be in that category. I am not in that category. Maybe one day I will be, but I am not now. Okay, so that's the thing, is if like this is like I almost think of like Roth IRA as like the poor man's way to get wealthy, because if you can spare $6,000 per year, you're going to be so golden. And here's why. Once you to answer this, why you should get one again is because the average return of the stock market, and why you should get into the stock market in general, like, however basic, intermediate, or advanced you want to get into it, is because the average return of the stock market is about 10%. Okay, what does that mean? So that means some years it's going to return 20%, and some years it's going to return 0%, and some years it's going to return negative 5%, and some years it's going to return 25%, like those types of things. Like there's a whole list on like Wikipedia, the S&P 500, which is just basically think of the S&P 500 as like a big conglomeration of all the biggest 500 companies in the stock market, and like sort of like their average, and kind of, I'm not explaining that well, but it's basically, it represents the whole stock market because the biggest pieces of it. Okay, and now 10%, in my opinion, is a little generous. And the reason I say it's generous is because that's the average of the stock market, and that is like if you just invested into what are called index funds, things that try to track the market and try to just keep up with what is going on, you could probably get better than that. You could definitely get lower than that, right? It's all going to depend year over year, but what you're looking for is like over time, because if you're starting in your 20s or your 30s, you're looking at literally 20 or 30, potentially 40 years of holding these investments. And you're not holding the investments per se. You could always sell out of them, but the point is it's a long-term play. You're not trying to get rich tomorrow. This is literally buy and hold type of stuff here. So that is really the power, and that's the reason that I say patience in the beginning of this. It's the reason I said patience is so important, because you need to have patience, because it's going to take a while. But that being said, just because it's going to take a while does not mean that it's not worth it. So this says 10. I would always go a little lower, just because I don't ever like to get myself super psyched up. Like if somebody says, oh, hey, you're going to make 10% in the stock market, I'm just going to underestimate a little bit. Also, I don't think this says before inflation, and inflation is normally like 2, maybe 3% from what I've seen, like historically. Again, that might fluctuate a little bit, but let's just say, if we're going to talk about the stock market, very average return, let's just say like 8, okay, 7 or 8. Okay, we'll see that here in a second. So let's honest to God, let's just use 7. These numbers are going to startle you anyway, so let's use 7, okay? Let's say that 7% is your average return on the stock market if you're using like an S&P 500 index fund type thing, okay? And what that means is if you're doing the index funds, like I said, and you're doing it over time, and that's just your rate of return. We're going to get into the actual investing part of it and what you pick, but let's just use that. So with all of that kind of like, somewhat put into perspective, let me show you literally the best thing that I've ever seen in my entire, like, this actually changed my life. I'm pretty sure it changed Amanda's life, and it's changed like a lot of other people's life because it puts it into a visualized perspective, okay? So this is a Roth IRA calculator. It's really no more than just like a compound. It's just like a fancy calculator built to, plug some numbers in here. But let's just think about this, okay? Let's run some examples. And I want to try to hit a couple different like sort of scenarios in a way, okay? So let's look at let's dissect what we're looking at here. This is, like I said, a Roth IRA calculator that asks your current balance, your annual contribution, annual investment return, current age, retirement age, yada yada. Okay. So let's do this. Let's say that we can do a couple examples. Like I said, let's say 0. Let's say our current balance is 0. Okay. So you're a random person watching right now, and you don't have a Roth IRA. You have no idea what the hell I'm talking about. You might just know me, or you might have just found me on Twitch, like the first dude commenting, and you have no idea what the hell I'm talking about, but you are just bored during quarantine, and you want to open a Roth IRA because some guy on the internet told you to, and that's where you're at right now, right? Okay, very nice to meet you. Let me show you what your life can be like if you just listen to what I'm talking about. So your current balance is 0 in this Roth IRA because you literally just opened it, which I will show you briefly on how to do that, okay? So your current balance is 0. You got nothing in there. And then, again, based on what I'm going to continue to go through here, you say, all right, Mark, that sounds fine. Like, I make whatever amount per year. I can definitely, whatever I have to do, don't go to Chipotle, a couple times a year, and don't, I don't know, stop spending money on stupid shit and whatever. And I can scrounge together $6,000 per year. I can absolutely do that. No problem. I will make myself do that. Perfect. So that means you start with 0 and you do $6,000 per year. So you've made that commitment to yourself. Okay, we're assuming you're going to do that every year. Like we said, it's 10, but we're going to say 7 for our annual investment return. Now, this is an interesting number because this is just this is an estimate. Like, it's an estimate on your average return. It could be higher, it could be lower. Like I said, right now, if I look at my Fidelity portfolio, which I will literally show you in 2 seconds, it's at 19. It's literally plus 19. I don't know. It's probably not going to stay like that forever. Obviously, things go up, things go down. You might buy different funds, make some bad purchases, good purchases, whatever. But let's just say 7. Okay, 7 is pretty conservative. You would honestly have to try to get something less than 7 over the course of your life, I think. Like, even if you were doing like the bare minimum, just put some money in, like I said, just the basic S&P 500 type stuff, this is probably where you're going to end up, barring a complete collapse of the economy and the world, really. And at that point, you're probably going to have bigger things to worry about. So I wouldn't even consider that as a problem, okay? So let's say 7, and let's say, what's your current age? Well, I don't know how old you are. If you're messing around, like just playing around on Twitch, I'm 24. I think probably most of the people I know are 24. This is important because the earlier you start, the better. Like, literally starting today is going to be even better than starting tomorrow, right? But at the same time, it could be any time. So let's for the sake of it, let's just say 25. Okay, we'll just say 25. And retirement age, I don't really want to retire at 65, but it had it in here, and we'll just do 65 because it doesn't matter. Okay, so like 62, 65, wherever. This actually, I don't think really is going to matter too much for our purposes. And this is interesting because I'm not sure actually how this calculates in here. I think I want to say this is actually probably going to subtract this from here. So let me just, maybe we'll play around here. Like I said, a couple things. Let's put 0 for there because I think I kind of put that in there with this. It's not really going to matter because, again, these numbers are probably going to shock you, okay? So let's do all this. So we got 0, 6,000 a year, 7%. We're 25 and we want to go till we're 65. So what this is going to do when we press calculate is this is going to show us what we're going to have in this Roth IRA. If we just do, like we said, this bare minimum, this is what return we get. So let's press calculate and see what happens. Drum roll for the slow computer that doesn't like to work when I'm streaming. Okay. Holy shit. Okay, let's see what we got here. So we got a result, and we got Roth IRA, and we got regular taxable savings. We got balanced at age 65, total principal, total interest, total tax. So let me try to break this down as best as possible. $6,000 per year over these 40 years. Good thing I did these easy numbers. $6,000 a year over these 40 years is this number right here. Okay? $24,000. We'll move down to the graph too, and this will be even easier to see. So what this means is over 40 years, this is ridiculously insane to me. I cannot believe that more people don't do this. I can't believe more people aren't watching. I can't believe anything. Okay? You put in $240,000 over 40 years, and you made almost $1 million. So your total balance is almost 1.2 million. Okay? I'm not sure who wouldn't take that deal. That sounds much better than like casino odds there, okay? And it's literally just chucking money away, okay? So let's move down here because this is actually a better representation. This is exactly what I was trying to poorly explain. You can see here that as you continue to go up 6,000, 12,000, 18, yada, 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 you're putting in a very linear amount because you're just putting in the same amount every year. But look at your balance, though. The power of compound interest. It's a beautiful thing. Look at that thing just shoot up to the moon. That is awesome. That is great to see. And this, I'm actually not sure about this. I didn't even have this kind of in the talk per se, but regular taxable savings, I'm almost positive that I'd have to think about how that really works out. But I think that you would have had to pay this amount perhaps if you did it the other way. But let's not even worry about that because that's not the point. The point is that this way, if you do it consistently, the numbers are going to spread so much that this is just absolutely the way. Like, it just seems like it to me. Don't take my word for absolute, Bible or anything like that. Because I'm, again, not a professional here. But this looks like a pretty good deal to me. Just saying, okay? Now, there might be some other things in here. You might not get exactly this because you have to pay fees on certain things that you purchase. Like when we get into, we touch on a little bit of the actual investing. You might have to pay a couple fees on, there's always percentage fees on certain funds when you, just for having them because somebody has to get paid for those funds to get managed. We're going to look at Fidelity here, which is who I have my accounts through. They've got to make money, right? So they got to make money somehow. However, consider this. I have never worked directly with a financial advisor to manage this stuff because what happened for me was my parents were nice enough to set this up for me when I was younger. And then I took the reins from the person that was managing it for them, and I was like, listen, let me do this on my own. So I transferred everything over, and voila, here we are. But the thing is, I don't know this for a fact because I don't know the hard numbers, but I know that when you involve more people, you generally have to pay more money. And when something isn't like that difficult and is relatively passive, I like to do it myself because I normally save money. And when you're talking about percentages and big numbers, stuff starts to add up. So I don't really know the average percentage that a financial advisor, or what I like to call, and sometimes useless middleman, unless you have a good dude, that can actually make you more money. Because, like, let's just take this for example. If I could have these results, right, and I could do it with like a couple minutes of work per year, more if you're interested, right? But really, at the very minimum, you could do this in like 30 minutes per year. Truthfully, you just put the money in and you invest it. Okay. which we'll get to. But if I could have these results by myself, or I could pay somebody else to do the same work for me, somebody who's not going to care as much about my money as I am, truthfully, nobody does, okay? Then why would I do that? Like, why would I pay them? Probably, I don't know what it is. I'll have to ask. I will literally have to ask, like, a financial advisor. I'm not trying to rip on financial advisors. There's a ton of really good people out there. I know a lot. They're all good people, okay? But I'm just saying that, like, there's value there, but at the same time, though, there are some people that are just going to try to, like, kind of rip you off or, like, tell you things that are, I don't know. I don't even want to go into it, but, like, it doesn't matter. Okay. If you can do something yourself and it's really not going to take you that much time and it's going to save you probably, like, again, I don't know, I'm guessing at least 1%. Like what are they going to take? Like 1% from you? Let's run another one. Okay. Let's say they literally take off 1%. So, like, one of those percentages points go to them. 1.197. Slow but surely. Congratulations, you're no longer a millionaire because you paid somebody to do your 30 minutes of work each year. You know what I'm saying? Like, I don't know. Like, I could be totally wrong there. Please, somebody explain me. Show me the error in my ways if I am. But it's just not something that I want to do. I don't even care. Like, I'd rather just do it myself. So that's the thing. Anyway, this is life-changing. I truly believe that. I need to find a better way to tell people about this because this is literally like the turning point for me when I figured out that this was the thing. So this is awesome. We'll come back to this in a second. But to go back through our things here, these questions have pretty much been answered in a long-winded way of, like, what it is, what's a Roth specifically, the kind of the differences, and then why you should get one. If I haven't shown you that you could just be a millionaire by just saving $6,000 per year for 40 years, if that doesn't, tickle you pink, then I'm not really sure what will. But, that's where we're at right now. Okay, so we have some of the theory out of the way. Let's talk about a little bit of the mechanics of this. Again, using our random person as example, just came on here, has no idea what a Roth IRA is, doesn't want to deal with any of that stuff. Probably like a lot of the people that aren't watching the stream right now are just like, oh, what am I doing? Why am I, not in a better financial situation or happier about, my lifelong ambitions? I don't know what to tell those people, but you should be watching the stream. That's what I would tell them. So, but how do you get one? Okay. How do you get a Roth IRA? Well, there's a ton of ways, especially nowadays. There's like literally, dime a dozen brokerages that have the ability to give you a Roth IRA. I am not going to go through every single one. I don't know if I have any referral links to any platforms. I don't really think I do for Roth IRAs, so I'm not even going to go into that. I'm literally just going to tell you what I did, and you can do that or you can use a different platform. Truthfully, they're all pretty much the same. I'm just going to show you what I've done, okay? And you can literally adapt it any way you want. There's millions of videos on YouTube about this stuff. I'm just trying to bring it to an audience that maybe hasn't seen it before. But, the extent to which that is working currently, up in the air. Hopefully it continues to trend upwardly. Okay, so how do you get one? Honestly, very simple. You go to fidelity.com, etrade.com probably, TD Ameritrade. I don't know, like a ton of them. We're using Fidelity, okay? I'm going to tell you exactly, like I said, how I did it. I actually transferred it over, as I mentioned earlier. I had it in a different, managed by a person at a totally different thing. That's a pain in the ass. I would recommend, if you can just avoid that, don't do that. If you have money, go get the money and bring it somewhere else. But get out of the crap, okay? Like, that is my best advice to you as far as that. Like, if you ever have, I'll talk about a 401k someday too. It's very similar to this. It's just kind of a little bit different. If you ever, as a total sidebar though, but it's somewhat related, if you ever have money in a financial institution that you're not either comfortable with or you don't know or stuff like that, get it out of there as soon as you can. Like, especially like 401ks are absolutely notorious for that. You're going to have, most of the time, if you work for a random, company, you're going to have a 401k through a financial institution that you probably have never heard of. Just get it out of there. Put it in like Fidelity or somewhere that's a little more mainstream. Just my opinion. I like knowing where my money is and controlling it, but that's just me. Okay. So let's talk about this. You have gotten to this point, okay, mysterious Joe Schmo individual, and you're like, okay, Mark, I totally understand. That makes a lot of sense. I can put the $6,000 away for 40 years. I'm going to do that. I want to be a millionaire. Tell me how I get this thing. Okay, well, I would say easiest way, again, but you're do it at your own volition, is go to fidelity.com and click on open account. Open an account here. And we'll do it like this. And there's a ton of different products that Fidelity offers. Not just Roth IRAs, not just retirement account things, but they have saving for retirement, investing and trading, education. This is kind of like a Roth IRA, but for education in a way. A bunch of different things. Okay, but without covering all of those things in this video, literally just Roth IRA. Open a Roth IRA. Click that. I'm not going to go through the process because I already have one, and it's like literally maybe like 5 steps, but they're going to ask you simple things just like you're opening a bank account. They're going to ask you your name, birth date, address, social security number, XYZ, element IP. Truthfully, here's the problem with me. I've opened so many bank accounts at this point. Like, it's like, I'm just snapping away and just flipping this stuff through. It's hard for me to conceptualize that people like literally might open one bank account when they're 16 and never open another one. So I apologize for that, but literally it's dirt simple. It's like if you just sign up for anything, it's easier than getting a new job. Truthfully, it's way easier than getting a new job. Like with the paperwork you have to fill out, it's ridiculously long. They're going to ask you for a couple things about you. The hardest question that I can remember that they ask you is what core position you want. And your core position is just where your money is when it's not invested. We'll get into that in a second, but it doesn't even matter which one you pick. Pick the one that's FDIC insured, or pick the one that's like a little money market thing. It really doesn't matter. The money shouldn't be in there for very long anyway. So that's the hardest question. The rest of the stuff is literally about you. Like, look in your baby book or something like that for the information. So after you have a Roth IRA, you've set up this new account, you have like your login to Fidelity and everything like that. What you need to do is you need to pick some mutual fund. Well, actually, the first thing you need to do is fund the account, obviously. Like we said, if you're going to fund it $6,000, then you should do that every year. And you can do it like, there's a bunch of ways, obviously, but there's 2 main ways that I would say. Once you have the account, if you are the type of person that has a paycheck every single week or bi-weekly, what I would do is take $6,000. I would divide that number by however many pay periods you have. So 52 or 26, whatever, or 12, you only get paid once a month or whatever it is. Take that number and literally take that straight out of your pay. When I had a paycheck coming in every week from my employer, literally had the money, I didn't even see the money. Like, the money never came into my checking account. It just went straight over to my Roth. Okay, so I would truly recommend that, because if you can condition people really and truly, I'm going to go on a slight aside here because it's important. People truly underestimate themselves. Like, there's people that I know that are like, oh, I'm so poor. Or like, not like I'm so poor, but like, I don't have any money because like I'm doing this, that, and the other. Listen, I know some people get into credit card debt. Okay. I know some people spend and live above their means, but like, I feel like a decent amount of people are not going to be able to spend money if they don't have it, So don't put the money where you can, like, if you care about your future, don't put the money where you can spend it now. And then hopefully that'll increase your self-discipline and you just won't want as much stuff and you're delaying that gratification. You got to condition yourself to do that. That's a hard thing. That's more of a psychological issue that we're not going to delve into, but that's what I would recommend for the Roth IRA. The alternate method is literally like once a year in the beginning or end of the year or whenever, put in $6,000. Like, you get $6,000 sitting in your savings account. Maybe that's you. Maybe you're scared that you might have an accident or something might happen and you'll need that. Then that's fine. Save that money, put it in an account. And then when you're ready at the end of the year and you're ready to like restart your stuff, throw that $6,000 in there. Whatever you want. I don't care. Either way is going to work as long as the money gets in there. But that's what you have to do. You have to fund the account first. That's step number 1. Okay. Once you have it, you got to fund it. Then what do you have to do? Well, you have to pick some investments, because putting the money in there is not enough. Okay, let me repeat that one more time. If you just take $6,000 and you put it in the Roth IRA, you are not going to make any money. Okay, that's not how this works. There's 2 steps. You got to fund it, you got to have the money, you got to fund it, and then you got to invest in stuff. If you want to manage your own stuff, it's really not that difficult. I'm going to show you how. What I would say for Fidelity, and I'm sure other platforms have this capability, I don't even need to be logged in to see this. You go to fidelity.com, you go to news and research. You come down here to mutual funds. So we can look at other stuff, but I'm going to look at mutual funds right now because that's what I mainly do, and I'll show you my portfolio here in a second. But I think this is a really good place to start because you don't, in my opinion, don't want to get into like stocks until you have messed around with a little bit of mutual funds and maybe like some index funds first, because there's generally much less volatility in like a bunch of companies. And that's a good point that I need to bring up. A mutual fund this was again very difficult for me to understand when I first started. So let me try to explain it. Everybody's heard of Tesla, okay? Everybody's heard of Tesla. And if you know of Elon Musk, if you're on Twitter, you probably hear that, oh, he tweets and the stock price goes up and down, yada, yada, whatever. I'm not going to tell you that I know how that happens, but it happens, okay? But the company has it's a publicly traded company. It has a stock, okay? So it has it goes up and down. It was real high at one point. Now it's a little back down to like 7 or something like that. But the point is that when you are an investor, like even if you've heard of that, maybe you haven't like actually played with that stock though. If you've heard of that, what effectively is happening is people are buying shares of Tesla at $700 and whatever dollars per share. And then when the stock price goes up, they make money. When it goes down, they lose money. That's oversimplification, but that's kind of how it is. My recommendation would be to not start playing around with individual companies until you, one, know a lot about the company, you believe in the company, you would be willing to hold that company for a very long time. That's a Warren Buffett type of strategy. Or you could day trade, but again, that's more of an advanced thing, I would say. But the point is that when you're trading one company and like one stock, one individual company, the company could crumble tomorrow, like something could happen and the whole company could go kaput. Could happen, might not happen, whatever. But when you're trading a mutual fund, what a mutual fund is like a bundle of companies, like almost like a pieces of a bunch of companies. So you're much less likely to lose all of your money in a sense. And most of the time they're actually formed via like categories. So let me give you an example. We'll see some here in a second, but let me give you an example. Actually, you know what? Screw it. Let's just go into it. But I kind of want to talk about this, but maybe we'll come back. So might come back to this screen. So but let's just talk about it now. Okay. So like if you're on this screen, we did the, let's read Shade's comment here because he's very into this media. I'm glad he's on. Okay, so I would recommend before you put any money to work, you open up a paper trading account, which usually starts with hundreds of thousands of dollars, puts an index fund and into stocks for a little bit and see what your results are from there. Put real money into a work-based account. Do what you do with comfortable. That's 100% accurate, Shane. Okay, so here let me put some insight onto that. I didn't talk about that because I've literally never done that, but that is a great thing to do and something that I should probably do more of because it would probably help me excel to where I want to go, like even faster, especially with things that are more, I would say, shorter term in a sense. We could get into really deep stuff. We're not going to. I will talk to Shane and get his insight on, kind of like the deeper things too, because like I'm not even in that space yet. But there's a lot more that you can do once you get into that realm. Like this is very simple. And not a lot of people do it. So if you can get this down and then you can continue to move on, I think you're golden. But that is a great point. Like maybe don't invest any money until you're more comfortable and you can do paper trading. I know Webull has it. I don't know if Fidelity has it. I don't think they do. Maybe Shane can tell us if Think TD Ameritrade or somebody like that has it. There's probably other platforms though, but effectively all paper trading is, from at least my understanding of it, it's like trading but not with real money. So it's like you could say It's like literally how it is, like paper trading. It's like if you wrote down like, oh, okay, today, what if I bought like 100 shares of Tesla, for instance? Well, that would mean that I would have needed this much money. I would have bought at this price, and easy numbers. Let's say you buy seven shares at $100 of some stock. So you have $700 you would have had to give in E-Trade. Perfect. So for in this case though, $100 per share, 7 shares or whatever. So you give $700, and that would be like, sort of your investment, and then you kind of see where it goes. So it's just like a way of like testing how good you are almost, and like literally paper trading before you actually put any money in. I'd recommend it. Like I said, I've just never done it because I honestly don't know why. I actually didn't know about it when I started, so that's probably why. But maybe I'll get into it one day. But regardless, that's a great way to safeguard against not losing all your money by not knowing what you're doing. But once you do get comfortable with that and you kind of know what you're doing and you want to actually do real money and all that other stuff, what I would recommend is, and you'll probably learn a lot about this as you paper trade, because you'll start to see like more of what you're really, what you're really kind of like keen on, what's working for you and all that sort of stuff. But again, this is my opinion, and this is what I'm going to do. If you use Fidelity, I would 100% recommend that you come into this mutual funds research thing. We'll kind of go over a couple of these things. I click this box right here, Fidelity funds only. There are better funds, but Fidelity funds purchased through Fidelity are extraordinarily cheap. Don't have any minimums to invest in. When I say cheap, I mean the expense ratio, and all that is like per year over year, or however, like whatever time period you own it, you're going to have to pay like, normally it's between like, 0 and 1% of whatever you're making. But again, though, you're always going to have to pay that. You would have to pay more if you had somebody else managing it for you. So keep that in mind. But let's just see what happens when we check this Fidelity funds only. And you can not do it. You can see down here that if you don't click that, there's a way more funds. I like Fidelity funds. You can check out anything else. But again, we're going to go over a couple different things in here. And I'm just going to exactly, like I said, show you the portfolio that I have currently, I've had for a while, and what we are kind of working with. So let's just press see results. And let's see how long this takes to load. And I should have gotten more water. Okay. All right. It's slow. Okay. So let's look at what we have here. We basically have a big chart of 318 funds that are all, again, this is just like a refining search on any other, searching platform, whether it's like a house or literally anything like that, or Amazon. You're just, filtering out different things. So we got Fidelity funds. We got no transaction fee. The thing you have to be careful of, and the thing that I literally just try to always filter out, is all these fees. Sometimes people will charge you fees just for buying into a fund. I'm like, no thanks, I'm good. That's fine. Sometimes it'd be a better deal long term, but I'm not trying to play that game. So I'm just trying to keep the fees as low as possible, and then whatever I make, I'm happy with. So there's that. There's active versus index. This is what I was talking about. Index are going to be cheaper from an expense ratio perspective because they're not really actively managed. Obviously, in opposite of actively managed. What is actively managed? That means like they're funds that some dude at Fidelity or group of people, effectively, or however you want to put it, or any financial institution, basically there's a bundle of funds, and they kind of just like pull, and they pick out certain ones. Like maybe like Amazon isn't doing too well or something like that, so they'll pull it, they'll put a different one in. That's my understanding of it. That might not be exactly how it is, but effectively you pay a little bit more for those because they're supposed to be better managed and actively managed and supposed to be better, so yeah, Shane, absolutely. Hit me with a difference. But for the funds here though, what I normally do is I click here and I click 10-year because I like to see how the fund has performed over time rather than just like 1 year or anything like that. And then I literally just look at these and I'm like, well, this is interesting. This one has given 19%, 17%, 17%, 17%, all over the past 10 years. And the expense ratios are, I don't know, you could call that high, you could call that low. I don't, it's probably like average, honestly. You can see this one down here is 0.03%. So it's an index fund, right? So it's a little lower than these ones, 0.71. But basically, I don't want to go too deep on literally exactly how to pick funds, because like I'm not an expert, okay? I'm just doing what has kind of worked for me, and and I've had success so far. Well, I mean, self-proclaimed decent success. Okay, so basically how I see this chart and what I'm looking at here is I'm like, okay, you can go deeper into this too. It'll show you like the full, like all lifetime performance of the first one, for instance, like the select software and IT. Okay, here's a couple things that I look out for. Let's read Shane's comment though. If for any reason at all you needed to access your money in case of emergency, for instance, if you have a regular IRA and take money out of it, you will get penalized and taxed. However, with a Roth, you can withdraw any contributions you make at any time without paying a penalty or taxes on that money. That's an incredibly important thing. Thank you, Shane, for bringing that up. And thank you for even further, in my opinion, what I think is, I don't like the Roth seems so good that I don't understand why people do traditional, is truthfully the case. Like I think there might be differences on who can put in Roth, who can put in traditional, but it's just like kind of crazy to me why that is the case. Like the Roth is much newer. I think like they put legislature in and they made this thing not too long ago. I want to say in the 90s. I could be totally wrong, but all I'm saying is it's ridiculous. Like it doesn't even make sense how good it is, and I think that this is why I'm trying to bring this to more people, because it's just absurdly good. That's all I can say. So anyway, appreciate that, Shane. Thank you very much. But here's the deal as far as the way that I pick these. Again, super simple strategy, probably way more that you can do. But again, I am bringing this from a perspective of you could do this by yourself in 30 minutes per year. Okay. And you don't even need to do that. Like you would need to do this like once perhaps, and then you could reset at some other point. But yeah. Exactly, Shane. So just Roth all day. All good. No problem, buddy. With these funds here, let's talk about this. What am I looking for? I'm looking for good long-term growth, so I sort by the 10 years, so it just gives me that kind of upfront. I wish it would do an all category. I don't know if you can do that, but it doesn't matter. So 10 years, good enough for me. So what has this done over the last 10 years? These are pretty good. Remember, the average is like 7 to 10. Okay, so it's pretty damn good. And then you pick that, and minus a little bit of expense ratio. That's fine. I'm good for paying for more. I'm still ahead. And then what do? I want good long-term growth. So then I come over here and I'm like, okay, well, technology. Okay, so this would probably be, if I was building a portfolio literally this second, I would probably take this one, and then I would go down to the next one. And I would say healthcare. Okay, that's fine. And then I would come down to this one, the third one here, select IT service and portfolio. Now, it's tough for me because I don't know if I would pick there's like you can see here 1, 2, 3, 4, 5, 6, 7. The first 7 are all health and technology. I don't really know if I want that many health and technology things. The thing that I look for, like I said, long-term growth, low-ish expense ratios, and then also some diversification in categories. Like if you take like 6 mutual funds all in technology and you invest in them, if something gets screwed up in the technology field, or like there's like a really bad thing that happens, your whole portfolio is going to go down. Okay, I'm not really with that. Like I don't think that's per se the best idea. So what I would probably recommend is to take like technology, and technology is an interesting one because like it seems like it's pretty bopping, and it's probably going to always continue to be pretty decent. But like something like health, for instance. Like if there's a really bad health scare, I don't know if there's anything, maybe going on now at some point, or I don't know. Actually, that might have an adverse effect, better effect. I don't know. It doesn't matter. Regardless, diversification, I think, is going to be your friend here. Okay, so pick some that are high in long-term growth, and then also that are diversified. So if I was going to pick a portfolio, and the other thing too is like you'll see mine in a second. I have 6 different funds that I've chosen. And it was a while ago, so I don't know where they are really at right now as far as like on this chart per se. But what I would say is go like technology and then health, and then maybe this consumer consumer cyclical, and then large growth, and then I don't know. I mean, there's maybe this communications one. I wouldn't probably go all the way down here. I'd probably pick like some more of these ones up here just because I'm not trying to lose that much. Like I truly, at the end of the day, okay, if this was something else, I might not believe in it as much, but honestly, technology seems like it's booming. So, that's the other thing. The only other thing that I would say besides long-term low expense ratio, some diversification in your categories is maybe come over here, check this index button. And then you can see I've clicked on these before. Like look for maybe one or two index funds because it's going to keep your expense ratios lower. And index funds, again, are meant to follow the market. So I don't know, maybe like pick up a couple of these just for fun, And again, here's the problem with all this. Like there's no actual exact science to any of this. So you're really going to have to play with it a little bit to see what you're really looking for and what ultimately, what is ultimately going to work for you and, what is performing the best. This is the one reason why people shouldn't manage your stuff is if you literally don't care at all about this. Like if you just want to give money to somebody to try to beat the market for you, then do that. But if you're okay with spending a little bit of time here and there to do this, then I would recommend trying to figure this out and do it for yourself. And I hope that this has given you kind of a decent thing. So with that, I know that I've been saying that I'm going to show my portfolio, and I have no problem with doing that. The only thing I'm blocking out is the actual account numbers and shit, because that would be stupid to show that. But this is what I have. So. And I can I'll kind of go through a couple of these things, but I'll also kind of explain a couple of the holes that I think I left in the actual thing. And let me, you can look at this all you want or whatever, but let me kind of go back and explain what the the process was. We were on that thing where we were saying like, okay, Joe Schmo, has an account, goes through, looks at those mutual funds, and then let's say you have, $6,000 or whatever. The reason that I have 6 funds generally is because when I started, I had $6,000 and I just invested. I try to invest evenly too. So this is really the last step. You've gotten your account. We went over the mutual funds research thing and we looked at some mutual funds, right? And then we picked, let's say 6 for all intents and purposes, okay? And let's say there are these 6 here, FNCMX and all these other ones that you see. So you have $6,000 in your account. You have 6 funds that you want to buy, and then you just buy like I would say, you don't have to do this, but I would diversify. I like to keep my portfolio relatively balanced, and because that's the point. If you're relatively balanced and you're diversified, then I feel like you're always going to have a pretty strong portfolio, as long as you're doing all those other steps and you're not investing in complete garbage, right? So. That I feel like all of those things, when you bring them together like that, is going to result in something which I believe is pretty impressive here. I have been, like I said, I think I had a custodial type account for a little bit when I was younger, and then I had every year since, I don't know how the math works out or whatever, but every year I am trying to do 6,000 per year. I know I posted on my Instagram story today that 2018 and 2020, I'm fully funded $6,000 per. 2018 and 2017, I want to say I was also $6,000. And then also the custodian. I don't remember exactly how all the stuff happened, but anyway, let me break this down, okay? When you put that money in, you're going to fund it. It's going to go into this core position that I was talking about that literally doesn't do anything. That's the first step. You have to invest. So then you pick out your 6 funds. We'll say it's these funds. And you put, again, we'll say that you just evenly distribute it. So you buy 1,000, 1,000, 1,000, 1,000, 1,000, 1,000. And then you have $1,000 invested in each of these. And it'll show that you have nothing left in your core position. And then at that point, you can sit back and relax and just let the thing take its course. I would, if you want to change it, if you want to mess with it, then, by all means, go ahead. But if you let that go for a year and then you come back, you put your next $6,000 in and you do that same thing, honestly, I think your life is going to be much better than if you did none of that, when you're later down the line. So that is, maybe some things kind of left out here and oversimplified. Overall, that is pretty much how I've gotten to the point that I'm at. And as you can see here, I'll try to break down like exactly what you're seeing if you've never seen like a spread like this before. All this is telling you is the last price of this thing. So like one share, I guess, of FNCMX, the mutual fund, was 114. That's a change of, $1.82 from the last time it did. And I think, correct me if I'm wrong, these are posted every day, like once a day. That's when this changes. So it went up a little bit, like yesterday, like on Friday, I guess, or whatever, as of today, or I don't know, whatever. I think it's just weekdays, like regular stuff. So it went up a little bit. Last trading day. That's today's gain and loss of what I have, and that's the reason is like we're just using this first one here. So I have almost 50 shares. It's like 49,571. That means that I made $90 on that one because it went up. And you can kind of see the math there. 49 times 1.82. There you go. And that's a difference of 1.6%. And then what is that in actual money? That's I made, what is that overall, like total gain and loss? That's almost $1,000, like on record, effectively, like all time, I guess, and 20% there, right? So this shows you like how much money I have currently, like the current value of each of these. And then down here is really like, obviously kind of like where it wraps it all up. So for instance, last trading day, I made $451, went up 1.35%. And my total gain and loss of all this has been about $5,395.99, or this is that number that I put in that one post, up about 19%. I don't know if that's good or bad. I would say it's probably good, considering that's an all-time figure and the average is, like I said, 10. Okay, I would assume that that's the case. And this is the total portfolio value. So it's almost $34,000 in my Roth IRA. I think that's pretty good. I'm not showing you this to brag. Let me be clear. I am not showing this to gloat in any way. This is, in my opinion, actually, like, I'm the type of person, like, I'm very happy of where I'm at, but I'm never satisfied. Like, I want to continue to grow, right? So I'm showing you this because this is very achievable, is the whole point of this. I'm not trying to like, oh, look at me, I have a Roth. That's not what I'm saying. I want other people to be able to do this. I want other people to know how to do this so they don't have to pay even more money for somebody else to do this. And that's what I'm doing. I don't want to be a financial advisor. It's not what I want to do. I want to show people how to do the stuff that I've figured out how to do. And just like give back, because I've gotten a lot from other people on YouTube and in life that has really helped me. So that's my journey there. That's the point that I'm doing all this. Now I want to do one more thing, and show you, like, for instance, maybe like one more Roth IRA, calculation or whatever. Because I did this to myself, and it would kind of be like a tough situation, because I don't actually know. This is an interesting thing. Like, I don't know if this is actually sustainable, or this is like some sort of weird reasoning that this is actually 19%. Now, one important thing to note is that all of these funds that are like really high in return are probably pretty aggressive funds. Like, they're trying to get high returns, and when you're trying to get high returns, there's a chance that you get low returns because they're more aggressive than conservative. So as you continue to get older and older, you're probably going to back off of that a little bit, because you don't want like something to happen when you're like 50 or 55 and effectively crush your whole portfolio that you've built up for so long. So I'm not there yet, and I don't care. I'm going to run this thing until the wheels fall off, until like I am at a point where like, well, okay, Nate, I need to slow down maybe, right? But if this like is like, if something anywhere close to this would be sustainable, like, you would literally have such a huge balance in your thing. I'm going to do it because I did it earlier and I was pretty impressed. So let me just do it here. So let's do 33. What is it? 33,788. So let's go back over to our trusty calculator. 33,788. Annual contribution, we'll say I continue to do that. We'll say my current age is 24. We'll say 65. We'll keep this stuff as it is, and we'll change this. If we change this investment return rate, this is the tough part, because I don't know if this is actually sustainable. I truthfully think that it's not, and I'm going to knock it down to 15, because I still think 15 is super high, but again, this is a total, like, absolute best ridiculous case scenario here. So we're going to go 15. So what are we saying here? This is like my portfolio or anybody else's that like is in a similar position. $6,000, 15%, and then just, you know, my figures as far as how long. I am, again, not showing you this to gloat. I'm showing you this to show you the power of compound interest. And one more thing, because this is really important. If you do this, you can, like, if you get into this, you don't have to do this in a Roth. Like, I know that there's actual restrictions on how much money you can put in, like in this instance, $6,000 currently. You could do this somewhere else and you just wouldn't have the same tax, you know, like implications. Like, it wouldn't have the same benefit from the tax perspective where you could take it all out. But doesn't mean you can't do it somewhere else, and doesn't mean you can't invest. Like, investing is literally how a lot of people get rich. So, and it's fun. So, like, again, to show the power of compound interest, this line is almost flat, and this blue line is the actual account balance, and it's literally $22 million. So, you know, it's ridiculous. I'm showing you it because it's crazy how fast stuff starts to add up if you can get high returns. And you can just, it's not even really about the high returns, okay? Again, this figure is probably going to be much closer to 10, okay? Let's do it with 10, though. And see what happens. Oh, $4.6 million. Much less, but nothing to sneeze at, right? So just put the money away. Like, just put the money. This is the key right here. If I could simmer all this down, boil all this down into one thing right here, this is it. Right here. Just put the money away consistently. That is why I give you the recommendation to pull it out of your check before you even have it. Like, before it even gets into your checking account. Like, just take it out of your check. Put it right in the damn Roth. Invest it. Like, I understand not everybody has the same, you know, like, circumstance and all that sort of stuff, but just like, just at least give it a try. It's going to benefit you so much. It's going to benefit you so much if you can just put the money away. So, honestly, that's pretty much all I have. I think I've done kind of what I want to do. This was an hour long. I didn't expect it to go that long, but I'm glad that it's somewhat like a round number here. I can kind of trim it down if I want to from there. But, you know, thank you, anybody that passed through on the live stream. This will actually be up because we're streaming on Facebook, Twitch, and YouTube. It should be on all those platforms. So if you want to check it out again, if you want to tell anybody about it, go ahead and do that. But yeah, any questions, feel free to hit me up at any time on any profile, and I will do my best to answer those questions. So with that, I thank anybody that was watching on the stream again. Really appreciate it. Anybody that clicks on it afterwards, thank you so much. And thank you, Shane. Appreciate it, buddy. And I will talk to you guys in the next one. See ya.